In the summer of 1720, London looked like the financial capital of a new age. The war with France and Spain was over. The Navy had carried Britain through a generation of conflict. Merchants were reopening routes, and the state possessed something more valuable than gold: a growing reputation for paying its debts. In the city, information moved through coffee houses, letters, brokers, and newspapers. A price chalked on a board in Exchange Alley could travel across the country before dinner and across Europe within days. Parliament had discovered that government debt could be transformed into tradable shares. Investors had discovered that a share could be sold more quickly than an old government annuity. And the South Sea Company stood at the point where empire, war finance, slavery, politics, and speculation met in one extraordinarily persuasive promise. Its name suggested oceans, colonies, and fortunes waiting beyond the horizon. Its charter connected it to Spanish America. Its shareholders imagined ships, silver, sugar, land, and trade. Its political allies imagined a solution to the national debt. Its directors imagined a rising share price. For a few months, all three visions appeared to be the same thing. The company's stock, which had traded near £100 in late 1719, climbed through the spring and summer of 1720. It reached roughly £1,000 in June, a tenfold rise in only a matter of months. Men who had spent their lives measuring wealth in acres and rents began measuring it in paper gains. Women invested. Clerks invested. Aristocrats invested. Foreign capital flowed toward London as the great French Mississippi scheme began to fail. Even Isaac Newton, the man who had calculated the motions of the planets and served as master of the Royal Mint, was drawn back into the market after selling earlier at a profit. The scene has been preserved for posterity as a carnival of greed. A crowd, drunk on easy money, chasing a fantasy. A few swindlers at the top, a great fool at the bottom. Then the bubble bursts, the music stops, and history moves on. That story is memorable. It is also incomplete. The object at the center of this story is not a gold bar, a ship, or a secret map of Spanish treasure. It is a paper proposition. The act and accompanying arrangements that allowed the South Sea Company to take over much of Britain's government debt in exchange for company stock. On paper, the transaction looked like financial engineering. The government would deal with one large creditor instead of thousands of small ones. Investors would receive a liquid share instead of an awkward annuity. The company would collect interest, earn fees, and perhaps profit from trade with the Spanish colonies. Everyone could claim to be solving a problem, but the paper contained a dangerous requirement. The company's shares had to remain valuable because the government debt was being converted at terms that made a high market price essential. The company needed investors to believe that future dividends would be enormous. It needed fresh subscriptions to finance old promises. It needed political protection. And it needed the market to mistake the circulation of paper wealth for the creation of real wealth. The surviving pamphlets show how quickly this logic became public. The archives also preserve the account of John Aislabie, the Chancellor of the Exchequer, whose purchases rose from prices around 348 in April to 760 in June. They preserve the speeches of defenders, the warnings of critics, and the proposals that promised dividends of 38% or even 50%. Somewhere between those figures sat the actual South Sea Company, whose original commercial business had never produced anything remotely like the riches implied by its stock price. So what really created the South Sea bubble? Public madness, private fraud, or a government debt deal that turned solvency into a story? And why have later histories so often made the crowd the main character? To understand the answer, it is necessary to begin before the famous rise. The South Sea Company was founded in 1711, while the War of the Spanish Succession was still consuming European resources. Britain had won important victories, but victory did not mean that the treasury was healthy. War had been financed through a mixture of taxes, loans, short-term obligations, and annuities. Contractors who supplied the Army and Navy were sometimes paid with promises rather than cash. The state survived by making new promises to honor old ones. That system was not unique to Britain. But Britain had built an unusually powerful relationship between public credit and private finance. The Bank of England had been founded in 1694 in exchange for lending money to the government. The new East India Company had used a related debt-for-equity arrangement in 1698. These institutions did not simply lend to the state. They helped transform state obligations into shares that could be traded. The attraction was practical. A government annuity might pay a fixed sum, but it could be difficult to sell. A share in a chartered company could be assigned, transferred, pledged, or sold with much greater ease. Liquidity had value. Creditors could accept a smaller or less certain claim if the new instrument could move quickly in the market. The government, meanwhile, could simplify its obligations and hope to reduce the cost of managing them. The South Sea Company was designed to compete with the East India Company in overseas commerce, but its financial role was present from the beginning. In exchange for taking over part of the government's short-term debt, it received a monopoly connected to trade with the Spanish colonies in South America. The Treaty of Utrecht in 1713 transferred the asiento, the contract allowing Britain to supply enslaved Africans to Spanish America, to the company. It also received permission for an annual ship to carry goods. The commercial opportunity was real but limited. The asiento did not turn the company into a second East India Company. Spain controlled access to its colonies. Trade was constrained by war, regulation, diplomacy, and geography. The annual ship was valuable as a symbol and potentially useful as a smuggling vehicle, but it could not support the extraordinary valuations soon attached to the company. As Helen Paul has emphasized in her economic history of the episode, the South Sea Company became a financial enterprise by default. The oceanic name was more productive than the oceanic business. The first debt conversion in 1711 was not yet a bubble, nor was the later conversion of 1715. In 1719, the company took on additional government debt. One documented transaction exchanged more than £1 million of obligations for newly issued stock. Investors were not merely buying a fantasy of trade. They were buying a claim attached to the fiscal capacity of the British state. That distinction matters. The company was not an empty shell in the modern sense. It held government-backed claims, enjoyed chartered privileges, and possessed political influence. Its stock could pay dividends. It could also rise because the market expected future debt conversions, future fees, future political favors, and future commercial openings. A company did not need a profitable fleet if its financial privileges were valuable enough. The crucial proposal arrived in 1720. The South Sea Company offered to absorb much of the remaining national debt. In return, it would receive the right to issue stock and collect an annual payment from the government. The scheme was a contest. The Bank of England made a competing offer. The two institutions negotiated with ministers and Parliament. The South Sea Company ultimately secured the arrangement, helped by payments and promises made to influential supporters. The exact mechanism was complicated, and that complication became an advantage. A complicated proposal could be presented differently to different audiences. To ministers, it was a reduction in the burden of public debt. To debt holders, it was a more liquid security. To politicians, it was a way to strengthen public credit. To directors, it was a platform for issuing more shares. To the investing public, it was a chance to own a piece of the national future. The formal transaction did not create wealth equal to the value of the shares. It exchanged one set of claims for another. The government still owed money. The company still depended on the government's payments. The company's commercial operations still faced the same Spanish restrictions. But the new shares could be sold in a rising market, and rising prices could make the whole structure appear more successful than it was. This was the first great contradiction. The South Sea Company was presented as a solution to the debt problem, but its success required the market to assign an extraordinary value to the company's promise to manage that debt. The more valuable the shares became, the more easily the company could issue stock. The more stock it issued, the more it needed high prices and credible dividends. The transaction did not simply convert debt into equity. It converted a government obligation into a market narrative. The numbers began to reveal the pressure. At the start of the year, South Sea stock was worth a little over £100 for a nominal £100 holding. In April, after the parliamentary approval of the major debt operation, the price briefly fell from about £310 to £290. That reaction is often overlooked. If approval was obviously good news, why did the price decline? The answer is that approval also revealed the scale of the obligation. Investors were being asked to believe that a company carrying vast government claims could produce dividends high enough to justify the price. The company answered the doubt with subscriptions. In April, the first money subscription offered £2 million in stock at £300 a share, with only 20% payable immediately and later installments spread over time. That was not a minor convenience. It lowered the cash needed to enter the market and allowed buyers to control a large position with a smaller initial payment. The second subscription followed soon after, with similarly generous terms and borrowing limits that allowed participants to obtain stock while postponing much of the cost. The arrangement resembled an option before the language of modern derivatives had settled. A buyer could commit to a future payment, benefit from a rising price, and hope to sell before the final installments became painful. If prices rose, leverage magnified the gain. If prices fell, the obligation remained. In the background stood the Sword Blade Bank, closely connected to the South Sea Company. Several South Sea directors had links to the bank, and the bank had earlier demonstrated the potential of debt repackaging. Around 1710, it had acquired government debt at a discount and benefited when the debt was exchanged for shares. The lesson was simple: control the debt before the public announcement, then profit when the government attaches a new promise to it. A modern historian can call that insider trading. A Georgian director would have called it business. The directors were not operating outside a financial system. They were operating at its center. The problem was that the system had begun to reward the appearance of success. Directors could use new share issues to support prices, pay political allies, and satisfy dividend expectations. The price itself became evidence for the next buyer. A man could point to a market quotation and say, "The company is worth £700. The quotation existed because men believed it. Men believed it because the quotation existed. The political machinery was equally important. John Aislabie, Chancellor of the Exchequer, supported the South Sea arrangement and became one of the most visible figures in the later scandal. Sir John Blunt, a financier associated with the company's design, understood how debt conversion and stock issuance could be combined. John Knight, the company's treasurer, was involved in the financial operations that sustained the scheme. Robert Knight, another central figure, would later escape Britain, leaving investigators with an especially frustrating absence. Support did not come for free. The New York Fed's historical account, based on the established record, describes the South Sea Company as winning the contest with the Bank of England through bribes to the government. Contemporary and later accounts differ over the precise routes, beneficiaries, and legal interpretations, but the basic fact of political corruption is not a tabloid invention. The company distributed fictitious shares and other inducements in a system where access to public decisions was itself a financial asset. The word fictitious can mislead a modern audience. It did not necessarily mean that every paper certificate was forged. It meant that shares were granted or recorded without a corresponding expense in the company's accounts, often to secure support. The University of London's Corinne Adder notes the figure of £574,000 in such fictitious shares. That amount was not the whole bubble, but it reveals the hidden cost of political influence. The company was not just persuading investors. It was purchasing the conditions under which investors could be persuaded. Then came the parallel story from Paris. John Law's Mississippi system had attempted a far more sweeping transformation of French finance. Law combined a bank, paper money, tax arrangements, and a large overseas company into a single system. At first it appeared brilliant. The French state had enormous debts and weak public confidence. Law offered a new architecture. But the architecture depended on confidence, and confidence could be damaged by restrictions, monetary expansion, and the realization that the company's colonial prospects were being exaggerated. As the Mississippi bubble began to collapse, capital and attention moved toward London. The markets were not isolated. Letters traveled. Agents acted for distant investors. Dutch funds, French money, British savings, and colonial connections met in the same exchanges. The South Sea bubble was therefore not simply a domestic episode caused by English greed. It was part of a European financial event. The movement of capital created a dangerous illusion. London's rising prices appeared to prove that Britain was more rational than France. Paris's collapse made London look like a safe haven. But the money moving into London did not make South Sea trade more profitable. It only made the market more liquid for a time. That distinction is the point at which the familiar morality tale begins to fail. The investors were not all fools. Some were arbitrageurs. Some bought in order to sell quickly. Some understood that the price could be detached from the company's underlying income and believed they could exit before others did. Others were not speculators at all, but debt holders who had been encouraged to exchange old claims for new stock. Some were women managing family estates. Some were provincial investors relying on correspondence in London. The market contained different motives, different information, and different levels of risk. Isaac Newton makes the human contradiction visible. Before 1720, he was not a helpless innocent. He was a wealthy administrator, a close observer of monetary affairs, and a capable investor. He had experience with the royal mint and with the mechanics of government finance. According to Andrew Odlyzko's reconstruction in the Royal Society Journal, Newton probably held around 10,000 units of South Sea stock at the beginning of 1720, alongside government securities. He sold much of his position during the early rise, apparently realizing a profit that may have been closer to £20,000 than the frequently repeated £7,000. Then he bought back in. The price had continued upward. The sale that had looked wise began to look premature. The market was announcing that the future was richer than Newton had calculated. Odlyzko estimates that Newton's eventual losses were at least £10,000 and plausibly more than £20,000, despite the fact that he died wealthy. His famous saying, that he could calculate the motions of heavenly bodies but not the madness of people, cannot be securely treated as a contemporary quotation. It appears in later tradition. The investment behavior, however, is supported by surviving records. Newton did not lose because he knew nothing about finance. He lost because knowledge and discipline are not permanent states. A rising market can transform prudence into regret, regret into reconsideration, and reconsideration into participation. The genius does not need to become stupid. He only needs to believe that the market has learned something he has not. The same tension appeared in the room where the government deal was negotiated. The formal language was about public credit. The private incentives were about control. The Bank of England and South Sea Company were bidding for the right to restructure government obligations. The company's offer gained political support, and approval followed. The arrangement was praised as a national service, but the terms placed enormous pressure on the company to sustain a high share price. Imagine the logic without inventing a speech. Ministers needed a debt settlement. Directors wanted the contract. Investors wanted a rising security. Each side could say that the other's interest would make the plan work. The government's debt would support the company. The company's market capitalization would support the government's reputation. Political support would support the price. The price would prove that political support had been wise. It was circular. It was also persuasive. The company then turned to the market with increasingly generous terms. The first subscriptions offered installment payments. The second allowed borrowing. Later subscriptions stretched payments over even longer periods. The famous rise to roughly £1,000 in June was not simply a rush of cash into an asset. It was partly a rush of promises to pay later. The contradiction became visible in the company's promised dividends. One public argument claimed that the South Sea Company could pay a dividend of 38% for 12 years. In August, the fourth money subscription promised a 30% year-end dividend and an annual dividend of 50% for 10 years. Such promises were not merely optimistic. They were a test of credibility. Could a company whose trade had never generated those profits suddenly distribute them because it held government debt? The answer was hidden by the share price. A high price made the promised dividend appear plausible as a percentage of the investor's original purchase, even when the underlying cash flow could not support it. The financial language was precise enough to sound scientific and vague enough to conceal the gap. The second subplot returned through the rivals. In 1720, nearly 200 new ventures appeared, many adopting the language of overseas discovery, technological novelty, or exclusive privilege. Some were genuine businesses. Some were speculative schemes. All competed for the same pool of capital. South Sea directors and political allies understood the threat. If investors had too many exciting alternatives, the company's own subscriptions might fail. Parliament responded with the Bubble Act, which restricted companies operating without proper charter or legal authority. It is tempting to describe the act as a simple attempt to protect the public. It was also a competitive weapon. The government helped create a market and then constrained rival issuers. South Sea was not only selling its own shares, it was narrowing the field in which investors could place their money. The policy backfired. The act shook confidence because it made the market's rules look political and unstable. Rival stocks fell. Leveraged investors had to find cash. Some sold South Sea shares to meet obligations elsewhere. The measure intended to protect the dominant company instead exposed the extent to which its valuation depended on privilege. By late summer, confidence was beginning to reverse. Foreign investors withdrew funds. The Mississippi collapse added pressure. The South Sea directors attempted further support operations, but each rescue made the structure more dependent on the next rescue. Stock prices no longer rose because the company had revealed new profits. They rose because buyers believed someone else would pay more. The Sword Blade Bank became the weak point. Investors who held notes or deposits wanted gold and silver. The bank could not meet the demand. On September 24, it closed. The panic spread to other banks. A share price collapse became a liquidity crisis, and a liquidity crisis made the paper claims of the financial system suddenly difficult to honor. The crash was fast, but the consequences were uneven. Some investors were ruined. Some directors lost fortunes and estates. Some political careers ended. John Aislabie was confined to the Tower of London after the parliamentary inquiry. Several directors were fined heavily, and Parliament seized estates associated with the scandal. Robert Knight escaped, an outcome that did little to soothe the public. Yet the cost to Britain as a whole was less catastrophic than the popular imagery suggests. Industrial output and overseas trade did not collapse into a long depression. Agriculture, the main part of the economy, was largely untouched. The The national economic effect was limited compared with the private and political damage. Britain's fiscal state survived. The company survived in reduced form. Guy's Hospital, founded through the fortune Thomas Guy made by selling South Sea Holdings, became one of the durable institutions connected to the episode. That does not make the crash harmless. Bankruptcy could mean the loss of a home, a marriage settlement, a business, or a lifetime of family security. The people enslaved through the company's asiento did not appear in the political debate as victims with claims of their own. Their suffering was treated as cargo, and the contemporary argument focused on the losses of European investors. Helen Paul has stressed this moral asymmetry. The financial crisis was narrated through ruined shareholders, while the human beings traded through the company remained largely invisible. The aftermath also changed how Britons talked about credit. Pamphlets multiplied. Satirical prints spread through London and across Europe. William Hogarth's early bubble imagery placed financial folly among religious, political, and social symbols. Daniel Defoe and Jonathan Swift used the affair to attack the government. John Gay later turned the moral atmosphere of the crisis into the beggar's opera, where the respectable world and the criminal world seemed separated by little more than clothing and legal language. The public wanted villains. It found them in directors, ministers, Jews, Catholics, foreigners, women investors, stock jobbers, and fashionable society. Some of that anger exposed genuine corruption. Some of it reproduced prejudice. A crisis can reveal a system's dishonesty while also giving people permission to blame whichever outsiders they already distrust. This is where caution is necessary. I want to be careful here. The South Sea bubble was not caused by one secret meeting in which a handful of men hypnotized an innocent public. Nor was every investor irrational. There were multiple causes. The structure of British war debt, the novelty and liquidity of joint stock shares, the end of wartime disruption, the inflow of European capital, the collapse of the Mississippi system, leverage through installment subscriptions, political corruption, weak disclosure, competitive regulation, and exaggerated expectations about trade. The term bubble can also be used too casually. A market price can rise above a conservative estimate of intrinsic value without every participant believing the same false story. Some buyers know the asset is overpriced and still buy because they expect to sell first. That behavior can be individually rational and collectively unstable. Information can be widely available but badly interpreted. A pamphlet may warn that the scheme is impossible, and the warning may cause prices to rise if investors assume that skeptics will soon be forced to cover their positions. Modern research has complicated the old image of universal madness. Historians and economic historians such as Helen Paul, Anne Murphy, Julian Hoppet, Larry Neal, Richard Dale, and Andrew Odlyzko have directed attention toward institutions, financial innovation, networks of information, and the actual mechanics of trading. They do not erase greed or fraud. They show why greed and fraud were able to operate through respectable arrangements. That is the deeper origin of the South Sea bubble. It was not born when a crowd first gathered in Exchange Alley. It was born when government debt, private privilege, and market liquidity were placed inside the same machine and then presented as mutual proof. The company's trade was too weak to justify its price. But the state's debt was large, the political rewards were immediate, and the shares were easy to sell. The financial story did not need to be true in full. It only needed to remain believable until enough people had exited. The most uncomfortable detail is that the public was not entirely deceived by hidden information. Much of the truth was visible. The company's commercial record was limited. The dividend promises were extraordinary. The subscription terms invited leverage. Rival schemes were being launched by the hundreds. Critics were publishing warnings. The market did not lack signals. It lacked a shared willingness to act on them. That is why Newton matters more than the quotation attributed to him. The point is not that a great scientist was foolish. The point is that he was informed, experienced, and still vulnerable to the social meaning of a rising price. When everyone around an investor treats an asset as the gateway to a new order, refusing to participate can feel less like prudence than self-exile. Money is never only money. It is status, belonging, evidence, permission, and hope. The South Sea Company also reminds us that financial bubbles are often sold as public solutions before they are sold as private opportunities. The initial language is respectable. It speaks of reducing debt, simplifying administration, improving trade, and strengthening the nation. The speculative language arrives later, though it may already be embedded in the structure. When private profit depends on a public promise, the line between policy and promotion becomes difficult to see. And when the arrangement fails, history often performs a second conversion. It converts institutional failure into individual folly. Directors become villains, investors become fools, and the system itself escapes into the background. That version is emotionally satisfying because it restores order. If the problem was simply greed, then the lesson is simply to be less greedy. But if the problem was a debt structure that rewarded rising prices, a political system that sold access, and a market that confused liquidity with value, then the lesson is more demanding. It asks who designed the instrument, who benefited before the public entered, who received shares that never appeared as costs, who controlled the information, who made the promise credible, and who was absent from the story altogether. The South Sea Bubble did not destroy Britain. It did not create modern finance by itself. It did not prove that every new company is a scam or that every investor is a gambler. Its importance lies elsewhere. It was an early demonstration that a government can use markets to manage its debts, that a company can use government privilege to expand its market value, and that investors can mistake the circulation of claims for the creation of wealth. 3 centuries later, the vocabulary has changed. The machinery has not changed as much as we like to think. Debt can still be repackaged. Risk can still be hidden inside complexity. A high price can still be treated as evidence of a high-quality asset. Regulators can still protect competition in one sentence and protect incumbents in the next. Financial innovation can still be praised as progress until the moment confidence becomes expensive. The enduring lesson is not that people are uniquely irrational. It is that people can be perfectly understandable inside a system that is collectively unstable. Newton wanted a return. Directors wanted a higher share price. Ministers wanted a debt solution. Investors wanted access to a rising future. Each desire made sense on its own. Together, they built a machine that could only work while belief continued to rise. Then belief stopped rising. There is another reason the old version remains attractive. It gives the story a clean beginning and end. In that version, the South Sea Company invents a fantasy, the crowd believes it, and the crash exposes the lie. But the archive is messier. It contains competing prices, delayed settlements, partial payments, altered instruments, and investors who could be buyers in 1 week and sellers in the next. The market was not a single mind. It was a chain of decisions made under unequal information. Even the phrase South Sea stock concealed several different economic positions. A holder might own ordinary stock, an annuity connected to the company, or a subscription that created an obligation to pay later. Prices in the newspapers could refer to securities with different settlement dates. When transfers were suspended during the summer, the quoted price no longer meant exactly what it had meant in the spring. A historian who reads a single price series without reconstructing the contract may mistake a change in the instrument for a change in public emotion. This is why the documentary evidence matters. A pamphlet can tell the historian what people wanted others to believe. An account book can show what one person actually did. A parliamentary speech can reveal the language of self-defense. A bank failure can show where promises encountered cash. None is complete alone. Together, they reveal a system that was simultaneously legal and corrupt, innovative and predatory, rational in parts and irrational in its total effect. The episode also resists the temptation to identify one perfect winner. Thomas Guy is remembered for making a fortune by selling South Sea holdings and using the proceeds to establish Guy's Hospital. But Aislabie's examination of investor records suggests that even Guy later repurchased some stock, in circumstances connected to short sales and market obligations. The supposed genius of the episode was not simply a man who saw the truth while everyone else saw gold. It was a participant navigating commitments that could change faster than reputations. That detail should sound familiar. In every financial age, later generations search backward for the person who understood everything in advance. Usually there was no such person. There were people who sold earlier, people who borrowed less, people who had better connections, and people who happened to need cash before the market turned. Luck is often edited out of financial history because luck makes a poor business lesson. The South Sea Company's most durable legacy was therefore not the disappearance of speculation. Speculation survived. Nor was it the end of public debt. Public debt became more central to Britain's power. The legacy was the discovery that government credit could be made tradable at enormous scale, while private institutions could capture the upside and distribute the downside. That arrangement would reappear in many forms, sometimes producing growth, sometimes producing disaster, and often doing both at once. The uncomfortable truth is not that the South Sea directors were uniquely wicked. It is that their conduct was made possible by ordinary institutions performing their ordinary functions. Parliament legislated, the Treasury negotiated, banks extended credit, newspapers circulated information, brokers matched buyers and sellers, courts investigated after the fact. No single institution had to intend a catastrophe for the incentives to point toward one. That is the part historians get wrong when they reduce the story to a fever of the crowd. The crowd was real, but it was the final visible layer. Beneath it lay a state searching for financing, a company searching for a business model, a banking network searching for leverage, and a political class searching for a way to turn public obligations into private opportunity. The mania was not the origin. It was the surface expression of a structure that had already been built. And structures, unlike crowds, do not disappear when the shouting stops. If this history changes the way you see the word bubble, leave the word debt in the comments. Not because the past offers a simple prediction of the future, but because every bubble begins with a promise about who owes what to whom. And if you want more financial history stripped of its legends and returned to its documents, subscribe. The next crisis will not arrive wearing a villain's mask. It will arrive as a solution.